1989, Dallas, Texas. Federal regulators walk into dozens of savings and loan offices across America and shut them down simultaneously. 1,000 banks, not one, not 10, 1,000 financial institutions collapse in a single year. $150 billion of taxpayer money will be required to clean up the mess. This is bigger than the 2008 bailout when adjusted for GDP. This is the largest financial scandal in American history before Enron, and almost nobody remembers it happened. This is the story of what happens when you deregulate an entire industry, let bankers gamble with deposits, ignore fraud for years, and then hand the bill to taxpayers. This is the savings and loan crisis, and it's the blueprint for every financial disaster that came after. Hit subscribe and comment which city you're watching from, because what happened with savings and loans in the 1980s is happening right now with cryptocurrency platforms, fintech lenders, and shadow banks. And the pattern is identical: deregulation, fraud, collapse, bailout, repeat. Savings and loan institutions were created during the Great Depression to help Americans buy homes. They were simple, boring banks. You deposit money, they pay you 3% interest, they lend that money as mortgages at 6% interest, they make 3% spread. Everybody wins. It worked perfectly for 50 years. From 1930 to 1980, savings and loans were the most stable, boring, predictable part of American finance. And that stability was guaranteed by heavy regulation. S&Ls could only make mortgage loans in their local area. They couldn't speculate. They couldn't invest in commercial real estate or junk bonds. They were limited by law to being boring, and boring meant safe. Then came 1980 and the deregulation revolution. Ronald Reagan was elected, promising to get government off the backs of business. His team believed regulation was killing innovation, that markets should be free, that competition would make everything better. The Depository Institutions, Deregulation and Monetary Control Act of 1980 was passed, followed by the Sarbanes-Oxley Act of 1982. These laws transformed savings and loans overnight. Suddenly S&Ls could pay whatever interest rate they wanted. To attract deposits, they could invest in commercial real estate. They could buy junk bonds. They could make acquisition and development loans. They could do everything that had been prohibited for 50 years, and the regulations that limited risk were removed, but the government deposit insurance stayed. This created a perfect moral hazard. Bank owners could gamble with depositors' money. If the bets paid off, they kept the profits. If the bets failed, the government covered the losses through FDIC insurance. What happened next was predictable. Criminals and con artists bought savings and loans specifically to loot them. Charles Keating bought Lincoln Savings and Loan in California and immediately started investing deposits in junk bonds and Arizona desert land deals. Don Dixon bought Vernon Savings and Loan in Texas and used depositor money to buy a fleet of private jets, a French chateau, and prostitutes for business partners. David Paul bought Centrust Savings in Florida and spent $90 million of bank money on a yacht, a Rubens painting, and European vacations. These weren't bankers. They were thieves with FDIC insurance, and federal regulators were told to back off. The Reagan administration's philosophy was that market forces would discipline bad actors, that government oversight was unnecessary, that freedom was more important than safety. The bets went bad fast. S&Ls invested billions in commercial real estate right as oil prices crashed in 1986. Texas and Oklahoma had building booms funded entirely by S&L deposits, office towers, shopping malls, housing developments, all financed with deposits from Kansas and Nebraska. When oil went from $30 to $10 per barrel, the Texas economy collapsed. The office towers stood empty. The shopping malls never opened. The housing developments were ghost towns, but the S&Ls had already booked the profits on these projects. They were using fraudulent appraisals to claim land was worth 10 times actual value, making loans to themselves through shell companies, literally just stealing depositor money and calling it banking. By 1987, the Federal Savings and Loan Insurance Corporation, which insured S&L deposits, was insolvent. It had $6 billion to cover $100 billion of losses. The entire system was bankrupt, but regulators hid it. They used accounting tricks to keep failed S&Ls open. They let zombie banks keep operating. They hoped the problem would solve itself. It didn't. 1989. The crisis became impossible to hide. The new Bush administration faced reality. Edwin Gray, the former Federal Home Loan Bank Board chairman, testified to Congress that we have 1,000 insolvent savings and loans. We need $150 billion to close them and pay depositors. Congress passed the Financial Institutions Reform, Recovery and Enforcement Act, FIREA, which created the Resolution Trust Corporation to take over failed S&Ls and sell their assets. The RTC became the largest owner of commercial real estate in America overnight. They auctioned off billions of dollars of buildings, land, loans, and toxic assets at massive losses. Taxpayers covered the difference. $150 billion adjusted for GDP is like $400 billion today. It was an enormous bailout. The criminals went to trial. Charles Keating got sentenced to 12 years for fraud and racketeering. He had bribed 5 U.S. senators who became known as the Keating Five, including John McCain. Don Dixon got 5 years for looting Vernon Savings. David Paul got 11 years for SunTrust fraud. Over 1,000 savings and loan executives were convicted of crimes. This was the last time white-collar financial criminals actually went to prison in America. Contrast this with 2008, when not a single major bank CEO was prosecuted. The savings and loan crisis established a pattern. Deregulate, allow fraud, collapse, bail out taxpayers, punish some criminals, but protect the big players, and then forget it happened. The lessons were ignored. In 1999, Congress repealed Glass-Steagall, which had separated commercial banking from investment banking. The same deregulation logic that destroyed savings and loans was applied to the entire financial system, and 9 years later the results were predictable. Lehman, Bear Stearns, AIG, Citibank, Bank of America, they all collapsed because they did exactly what S&Ls did. Gambled with depositors' money on real estate using leverage and fraudulent accounting. Except the 2008 bailout was $700 billion and nobody went to prison. Subscribe now and share this with someone who thinks deregulation makes markets safer. Because the savings and loan crisis proved that when you remove rules designed to prevent fraud, you get fraud. When you let bankers gamble with insured deposits, they will gamble and lose. When you delay closing insolvent banks, the losses grow exponentially. And history shows us that financial crises follow the exact same pattern. Deregulation, fraud, collapse, bailout, no prosecutions. Then everyone forgets and does it again 20 years later.